Hi guys, it's Stock Curry, and all of the major economic news and earnings have already come out, and the market continued to go up despite them being bad. So is this a sign that the bottom is in, or is the market just delusional? I'm gonna let you know in today's video, so let's get into it. Last week on Wednesday, Jerome Powell spoke after the Fed meeting, and even though he was fairly hawkish and told the markets very clearly that the Federal Reserve was not going to cut rates in 2023, the market ignored him and continued to rise anyway. Then, after the close on Thursday, a number of major companies, including Alphabet, Apple, and Amazon, all reported earnings. They all missed earnings. The earnings were horrible, and the stock market barely fell at all. Now, the question to all of this is this the bottom? Because a lot of times when you get all of this really bad news, but the markets continue to rise, it's a very good indicator that perhaps the bottom is in and the market is going to start rising from here. Well, I'm going to explain a little bit more detail, but first, let me give you some more information about how the economy is actually doing. On Friday, we got the unemployment data for January, and the U.S. added 517,000 jobs, while unemployment fell to 3.4%, the lowest in 53 years. This was significantly above analyst expectations, but it should be noted that very often we'll get these outliers where we'll get one major month only for it to drop again in the following month. That's exactly what happened in July when we got 568,000 jobs added, only for it to continue to decline the month after. So the job market shows that the economy is very, very strong and that a number of jobs are being added. Everybody's doing great. Or does it? As I explained in a video a while ago, the job market includes a combination of both part-time jobs and full-time jobs. What it does not clearly show are how many of the jobs added were part-time versus full-time. And what some other data that we have, specifically the housing data, shows us is that in the household data, the number of people working at a job is declining. And this falls right in line with our layoffs that we keep seeing over and over and over again from a wide variety of companies, that people are getting laid off and fewer people have jobs. So why then are the number of jobs increasing at such a rapid pace? Well, the reason is because a lot of people are going out and getting part-time jobs. They can no longer afford to pay their bills. They can't pay their rent. They can't pay their gas. They can't pay anything. So they're going out and they're getting part-time jobs to supplement their full-time jobs, while at the same time, other people are getting laid off. The net effect is a massive amount of increase in the number of people working part-time, second, and even third jobs. And this makes it look like the economy is very, very strong with a very strong job market. But in reality, it's just people working part-time jobs to try to pay their bills because their full-time jobs no longer provide enough income for them to pay their bills. In other words, people are really struggling and things are getting worse, not better. Now, despite ignoring the Federal Reserve on Wednesday, the strong jobs report has some traders betting that the Fed might actually raise rates more often than the market is currently pricing in. With employers ramping up hiring across industries, investors say it's difficult to imagine the U.S. slipping into a recession soon, presumably a good thing for risky assets such as stocks. Yet, some investors took away a different story. They worry that the good news for the economy might in fact be bad news for the markets if it pushes the Federal Reserve to tighten monetary policy more than they expect. Now, why might the Federal Reserve do this? Well, it's because a strong job market can lead to inflation coming back in the months ahead. And the Federal Reserve wants to stay on top of inflation. They want to get inflation down. And one of the ways they can do that is by creating a bad job market. So the Federal Reserve is more likely to continue raising rates as the job market remains quite strong. Following the release of the jobs report, traders increased bets that the Federal Reserve will raise interest rates 2 more times this year instead of just 1, something that could ultimately put more pressure on the markets. And in another sign that consumers are not doing well, more shoppers are turning to dollar stores for groceries. Rising food costs are pushing consumers to get more creative about where they go to buy groceries. Discount dollar stores are becoming a key destination for affordable essentials. As consumers continue to struggle and they're unable to pay their bills and even buy food, consumers are turning away from brand names and they're turning more and more towards generic name food brands, as well as the food that is near expiration that's often sold at a discount retailer. As such, while this is bad for the economy, it could be good for certain stocks, especially those stocks that offer these discount services and goods. 11 stocks that you might want to consider buying, which are all in the discount store segment, include Big Lots, ticker BIG, Five Below, ticker FIVE, Dollar General, ticker DG, Dollar Tree, ticker DLTR, PriceSmart, ticker PSMT, Burlington, ticker BURL, Grocery Outlet, ticker GO, Walmart, ticker WMT, Costco, ticker COST, Ross, ticker ROST, and Ollie's Bargain Outlet, ticker OLLI. Not included on that list, but also a stock that does quite well during times of recession, includes McDonald's, ticker MCD, because of their low-priced meals. And it's not just food that consumers are struggling to pay bills on. Auto loan delinquencies are rising as well. The share of borrowers who are 60 or more days behind in their auto loan payments was 26.7% higher in December than it was a year earlier. And as consumers struggle to pay their bills and they're pulling more and more money out of their savings accounts, as well as spending more and more money on credit cards, banks are now borrowing unsecured cash while deposits flee. U.S. banks lost deposits at the fastest rate on record in the second and third quarters of last year in data that goes back to 1984. That marked the first time since 2010, that's right, the Great Recession, the financial crisis, where 2 consecutive quarters of declines occurred in a row. It should be noted, however, that banks aren't in dire straits yet because the banks saw record inflows of deposits during the pandemic while trillions of dollars in U.S. spending were created. However, those outflows are now going out of the banks as consumers pay for things like food, groceries, and their auto bills. So things aren't dire yet for the U.S. economy, but certainly there's a lot of signs that things are getting bad, and those bad things could turn worse. And it's not just the publicly traded companies that are struggling either. Private companies are struggling as well. Nearly 2,000 CEOs think their companies will not be able to make money in 10 years. Nearly 2,000 CEOs recently polled say their company won't be economically viable within the next decade. That's almost 40% of the total number of CEOs surveyed. As companies continue to lose money, layoffs will mount both in the private sector and public sector. Those layoffs in turn will lead to more unemployment and more decrease in consumer spending. That in turn will make a recession worse, as that decrease in consumer spending causes companies to do more layoffs, which in turn reduces consumer spending more, which in turn causes more layoffs, which in turn reduces consumer spending more. And the cycle continues until the Fed does a true pivot where the Fed actually starts quantitative easing again and lowering interest rates. Right now, the Federal Reserve continues their quantitative tightening. Even once the Federal Reserve is done raising rates at some point this year, they will continue their quantitative tightening. What that does is it pulls money out of the economy, and as more and more money comes out of the economy, it increases the chances of a recession and also decreases both banks as well as other company earnings. It's all bad news for the stock market over the long term, even though economically things are really good right now. And in another sign that companies continue to see a decline in the growth that they've had over the past few years, cloud leaders Amazon, Google, and Microsoft show that the once booming market is cooling down. All 3 companies reported a decline in growth in the cloud services sector, and the cost cutting could stick around for at least another 2 quarters, Amazon said. So that's what's going on economically. The fundamentals remain quite bad, and all signs are still pointing to a recession here in the United States at some point towards the end of this year. Now, the technicals would point to something completely different. The stock market continues to rally despite the fundamentals being bad and actually getting worse. I'll explain why in just a minute, but first, let's take a look at the week ahead and see what kind of economic news is coming out, as well as take a look at the earnings that are coming out this week as well. In the economy this week, the U.S. trade is in focus, and Federal Chairman Jerome Powell is also scheduled to speak at an event in Washington. On Tuesday, the U.S. Commerce Department reports U.S. exports and imports of goods and services. The trade deficit shrank by more than a fifth in November. It'll be interesting to see if that can continue in December. Also on Tuesday, Federal Reserve Chairman Jerome Powell sits for an interview at the Economic Club of Washington, D.C. Then on Wednesday, New York Fed President John Williams will be interviewed at the Wall Street Journal. And the other major news comes out on Friday with the U.S. Consumer Sentiment Report. Consumer sentiment improved in January, but we'll have to see if that continued in February. Keep in mind that one of the major things the Federal Reserve is trying to monitor is consumer sentiment. They want to make sure that consumer sentiment is continuing to get better, because if consumer sentiment gets worse, that could actually lead to inflation rising once again. So it's one of the factors that the Fed is looking at, and it might affect the markets a little bit on Friday. We'll have to keep our eyes on that one. Now let's take a look at the earnings coming out this week. We don't have any major earnings this week, but there's still a few that you might be interested in. Monday after the close, we have Pinterest, Activision, Blizzard, and Take-Two Interactive. Then Tuesday after the close, we've got Chipotle. Then Wednesday before the open, we've got Uber and CVS. And then Wednesday after the close, we've got Walt Disney, as well as Affirm and Robinhood. Thursday before the open, we've got PepsiCo. And then Thursday after the close, we've got PayPal, Cloudflare, and Lyft. So that's what's going on with the economy and the earnings this coming week. Let's take a look at the technicals, because the technicals have a completely different picture from the fundamentals. It's very important to understand that the market will eventually get in line with the fundamentals, but it can often take many months and in some cases even many years for the market to get in line with the fundamentals. So even though the fundamentals of the economy remain quite bad, with company earnings continuing to decline and the jobs actually getting worse, even though they appear to be improving, and people struggling to pay their bills, as evidenced by a slowdown in grocery spending, as well as an increase in the delinquency on auto loans. All of this points to consumers being in really bad shape and the economy getting worse and entering a recession later this year. And the stock market will eventually get in line with those fundamentals and fall. Certainly, the long-term outlook on the stock market remains quite bearish. However, in the short term, the stock market is going to behave very differently, since the stock market in the short term will trade based upon the market sentiment, that is the psychology of traders, as well as the technicals. So let's take a look at the technicals right now and see how the stock market might trade over the next 3 weeks. On the daily chart, the stock market became overbought on Thursday. We did have a slight pullback on Friday, but we still have a gap to fill from Wednesday. So certainly there's some indication we might get a little bit more of a downturn before we continue higher. And the other thing is the fact that the market was overbought on Thursday might indicate a little bit of bearishness in the short term, say over the next couple of days. But on the weekly chart, the market is extremely bullish, with the RSI now having risen above 50, which points to bullishness. We also have a W-shaped pattern on the QQQ and the overall market. This is a very, very bullish pattern here on the NASDAQ, and it indicates that the market will probably rise over the next 3 to 4 weeks. Now, it doesn't mean the market's going to rise every week. We might get one down week in the next 3 or 4 weeks, but overall, the technicals point to at least the NASDAQ rising another 7% before hitting very strong resistance at the 50% Fibonacci retracement level. That will put the QQQ at $328, or about 7% above where it is now. So the technicals indicate that the NASDAQ will rise another 7% before topping out. So that's what's going on in the markets this week. I hope you guys got a lot out of this video. If you did, be a good friend and share this video with your friends and family. I also wanted to let you know we have a free newsletter that I am starting on Monday morning. If you want to get that free newsletter, then go sign up at stockcurry.vip/newsletter. That's stockcurry.vip/newsletter. What that newsletter includes is a market recap from last week. It'll go over all of the economic news that's coming out this week, as well as what time that economic news comes out. It also includes some technical analysis and a general overall look at the markets. It's everything you really need to know to get prepared for the week ahead. It is a free newsletter that will be going out every Monday morning. So get yours for free at stockcurry.vip/newsletter. I hope you have a lot of success trading. Don't forget to hit the like button and subscribe. And if you missed the video that I made about the earnings that came out on Apple, Amazon, and Alphabet, make sure you go watch the last video that I uploaded here.